Hey everyone, the markets have been less than kind this year, so I wanted to give you a market update and share some of the strategies that I've been implementing in clients' portfolios to help alleviate some of the volatility and risk, all while positioning your assets for appreciation once the market does settle down. If you find this helpful, make sure you share it with one of your friends and coworkers. Let's start with a brief market update. As you may have heard, we entered into a bear market earlier this year, meaning there has been at least a 20% decline from the market highs. Year to date, the S&P 500 is down 19%, the Dow Jones is down nearly 16%, and the Nasdaq is down 28%. A typical bear market lasts between 12 and 18 months, so if that's the case this time around, we could be seeing the light at the end of the tunnel some point in the near future. But there are a few risk factors that need to be managed. Most significantly is inflation and the increasing probability of a global recession. The Consumer Price Index is a tool used to measure inflation. And needless to say, the most recent CPI report was pretty disappointing. It showed that inflation is still on the rise. Current data suggests that there's a high probability the Fed will raise interest rates an additional 75 basis points later on this week. When rates increase so much in a short period of time, it puts pressure not only on the US economy, but the worldwide economy. This is what's leading to fears of a global recession. Many countries have been facing difficulties post-COVID, so now with additional pressure being put on from the US and a rising interest rate environment, that could have its consequences. So the main question is, what do we do from here? Like, where do we turn? What action steps can we actually take? And I've been very active in client portfolios, so I want to share 2 actions that I've been taking to mitigate risk as much as possible. The first thing I've been doing is replacing growth stocks with value-oriented stocks. The past decade, being overweight growth-oriented stocks has been extremely profitable. Since 2012, stocks like Tesla have been up 13,000%. Nvidia was up 4,100%, and Amazon was up 1,200%. Really some incredible turns over that period of time. If you were overweight that growth and tech sector, then you knocked it out of the park. But it was a completely different landscape than what we're dealing with right now. I mean, just think about it. Interest rates were at nearly zero for a decade because we were coming out of one of the worst recessions ever in history. The housing market was increasing steadily, and oil prices were pretty fair during most of that period. Those factors are exceptionally good for growth-oriented stocks. Where are we today? We're at a time when inflation is the highest it's been in over 40 years. Food and gas prices are going through the roof, they're out of control, and interest rates are crushing the financial markets. We have to face it, we're just in a different environment than what we were in before. It's not all bad, it's just very, very different. The investments that we were in aren't going to act like they once did. It's not to say they'll never be that way again, it's just probably not going to be for a while. Instead, we need to look at companies that are profitable now, today. Not in 10, 20, 30, 50 years from now, but companies that are profitable today and preferably paying a dividend. That's why transitioning into more value-oriented stocks is more appropriate. In December of 2021, I began shifting clients from growth-oriented stocks into value-oriented stocks, all while collecting dividends throughout the year. Now, value companies aren't as attractive as a lot of the growth companies or the tech sector. They're not, creating AI or doing time travel. They're not doing any of that. But instead, what they're doing is they're profitable today and they're collecting cash and paying a dividend, and producing cash in an environment where the market's declining is extremely important. The second strategy I've implemented is investing in energy. The world is in a transition between how it creates and consumes energy. And over time, the world may eventually be 100% running on renewable energy. But more than likely, it's going to take a few decades before we get there. In fact, the US Energy Information Administration projects an increase in natural resource consumption over the next 30 years. The demand for energy is extremely high, but the supply isn't there to meet the demand. Goldman Sachs reported that there is a 400,000 barrel deficit per day. Without enough supply, that leads to higher pricing in the energy field. And generally, when there are higher prices in the energy field, that means profit margins are increasing as well. I believe the energy sector is an appropriate and profitable area to invest our money right now. While there's cyclicality and volatility within this sector, I believe the longer-term goal of collecting dividends and hedging against inflation can be accomplished in this sector. In March of this year, I began adding exposure to client portfolios within companies like Exxon, Chevron, Schlumberger, and a Vanguard ETF. In June, I increased that exposure as the world demand was increasing more energy. And I wish we had a larger position at an earlier time, but nonetheless, the exposure that we did have helped in limiting losses that would have occurred if we stayed in growth. I hope you guys find this beneficial. So my goal is to keep you up to date in terms of what's happening in the market. If you want to stay up to date with the individual stocks, many times I'm incorporating in the portfolios, then you can subscribe to the channel. I go over a detailed analysis over most companies. And if you have any questions, comments, feel free to click the link in the description down below. Be happy to set up a one-on-one meeting and catch up with you all. I hope you guys are doing well, staying healthy. See you soon.